72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you go.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Another 1,200 point drop. What's going on? Well, I'm going to explain. First of all, we are not right back to where we were last Friday. Almost, but not quite. The catalyst was different today. Last Friday, the catalyst was that 300,000 job number. The attitude was, why do you need bonds? Who needs to buy a bond for safety? That's a great economy, 300,000. Everybody dumped their bonds. The problem is we didn't have the institutions participating. They weren't buying the bonds. They weren't selling the bonds. So the volume dropped from an average of 5 to 6 billion a day, that's what you really need per day, down to about half that. That was the problem. The market's set up for the computers to kick in when it's light volume like that, especially when there's no institutions participating. So the circuit breaker tripped. Computers start dumping bonds like crazy, and that's what happened last Friday. Then we had a rally on Monday because it wasn't a true crash. For a true crash, you need to have credit spreads, which are right now at 77. You've got to have at least 250 to 300, not plus 77. It doesn't make any sense. So, and last Friday, we didn't have IWM, small mid-cap symbol, IWM red. You have to have IWM red. In other words, yields, like what happened today, yields hit 4.5, the kill zone. Last week, they didn't come close to the 4.5. I should say we came close last Friday, 4.46, 4.48. But never hit the 4.5. So IWM never turned red. So let's compare. So last Friday, it was a fake crash. We proved it on Monday when all of a sudden we had this big short covering rally. To have a crash last Friday, we never hit that 4.5. IWM never confirmed the crash, turning red. That never happened. And credit spreads, to begin a crash, have to be around plus 250 to 300. We were only at 77. That's last Friday. So it was a fake crash, and Monday we proved it. So let's fast forward to today. So today what happens is we hit 450. That's the kill zone. Now, I know last week and the week before and the week before, we were hitting 4.50, 4.6, 4.75. No correction, no crash. But 4.5 is the beginning of the kill zone. Well, here's what happened today. We hit 450, and that's the kill zone. IWM turned red. It confirmed. See, that's the difference. Last week, Friday, we didn't have IWM confirming, and we didn't have the volume either. You got to have that volume. You got to have big volume during a crash, at least 6 billion, 5 billion. We didn't have that. So today, we had another fake crash. Now, even though we hit the 450, kill zone, check that block off. Okay, that's good. IWM confirmed the sell-off, turned red. Check that box. That's good. But no crash because, again, we didn't have the volume. We needed 6 billion trading. We only had about half of that. And here's the big one, credit spreads. Just like last Friday and today, you don't have a crash unless the credit spreads are at 250. start 250, 300. We didn't have that. So both these corrections had different reasons, okay? And one was the 300,000 jobs. Everybody's saying that's a terrific economy, and therefore we don't need bonds. And today was totally different. We finally hit that 4.5, and IWM turned red. You always got to watch IWM. Remember, yields, when yields rally, they hit that 450, yields and IWM are a truth serum. Not the TV jibber jabbers, not the Jim Cramers, not that other guy, I can't think of his name either half the time. Payne, these guys, they're not the truth. When someone says, what do you think the market will do? You just tell them, go look at IWM for confirmation and go look at yields. So today, when this market crashed, we went right back up again. And we're only down, we went from 1,200, we're now down 326, I think. So we had a big recovery, big short covering rally again. Why? Because there was no crash, so people started to cover their short positions. Now, if we had the volume of 5 to 6 billion, we wouldn't have had this short covering rally where instead of being down 1,200, we're only down 314. This thing would be going down big time, but that's not what happened. So we're caught with these problems with we don't have institutions participating in our market. That's the problem. And that's why we're getting jerked around. 1 minute you're down, next minute you're up. Light volume, it can be a killer. No institutions participation, that's what that means. It's a killer. So you get no crashes. You get inconvenienced. So you got to really know how to trade these markets. Now this morning, I said to my members this morning, I said, look, the only stocks that are doing well right now are the 4 machine stocks. And if they break out to new highs, okay, and if you aren't in them, if you weren't already in them, you didn't already buy those 4 stocks that makes the chip making machines, and you want to get in, you've got to make sure you start out with a scout. That's just 25 shares or less. You can even do 1 share. And then we have a test that we developed here at Phil's Gang on our chart that if that test is positive, then you can start buying. If it's negative, you don't. And the test is really quite simple. So you have to have that test. So the test it will fail. It keeps failing. So again, that's why today we had, again, once those 4 stocks, they broke into new highs, and that's why I told the people who weren't in them, be very careful, wait for a 2-day test, because you don't know what's going to happen. The markets always do what they're supposed to do, but never when they're supposed to do it, especially when you don't have participation of the big boys. So remember, the circuit breaker, these computers, they've been designed to kick in for exactly what's happening. When institutions aren't participating and the volume is terribly low. I don't even know, I think the volume today was what, 1 billion? It was very low. You need 6 billion, 5 billion. That's why the computers kick in and they start trading. So that 1,200 point drop, that 1,200 point drop last Friday was triggered by jobs, 300,000, and this was triggered by, again, we finally hit that 4.5, and then if IWM didn't turn red, it would have never happened. But because it turned red, we had a confirmation this pullback at 1,200 was real. Last Friday it wasn't, but this was real. But we need that one more push to qualify it as a crash, and it didn't happen. That's volume. The other thing I talked to my members about this morning was, you got to remember XLK. What is XLK? XLK is an ETF. It is the engine of the S&P 500. It has the AI infrastructure stocks. Again, XLK is tech. It's an ETF. That XLK is inside the S&P 500. It has infrastructure stocks, NVIDIA, Microsoft, Apple, MU, AMD, Broadcom, Intel, LRCX, and AMAT. That's in that XLK. You got to watch that XLK because when XLK does terrible, it's going to take your S&P down. When XLK is doing well, it pushes the S&P up. So you can judge if you're in the S&P, you can judge if your S&P is going to go up or down by watching XLK. That's very important. So now the other thing is too is if your big tech stocks that I just gave you, if those are doing well, then again your cyclical stocks will start doing well. They did terrible today. The cyclical stocks are our economy stocks. Those are our 4 economy stocks. And those are extremely important. So you can tell if we're going to have a crash or not, or it's real or fake, by just looking at your XLI, your XLB, XLY, and transports, IYT. This is not hard stuff. It's just stuff that Wall Street doesn't want you to know. It's stuff they won't teach. This is why retail investors lose 85% of the time. So, let's take a look. So the NASDAQ is only down 404 points. So remember this, and I'll show you. This may help you. So if you look at the group of stocks you need to start following, first of all, you got to follow IWM. That's the important one because that's the big guy. All right, that's the one. Remember, IWM is a true serum. Your yields are a true serum. If your yields are going up, it tells you the direction of the market. If the yields are heading up like it hit today, 450, and it hit the kill zone, it's telling you you're going to have a big correction or a pullback. Look at IWM immediately. If it turns red, it's confirmed. If S&P and XLK don't turn red, they just stay green, and you got IWM red out of the 3, then you got a real correction going. But you've got to keep following, again, the 4 biggest stocks right now. What's keeping the whole stock market up is those 4 stocks. And those are the 4 big, the AI chip machine makers. You've got LRCX, AMAT, and they're still acting very well. Even with the 1,200 point drop, they showed relative strength. Those are the only ones that are really showing relative strength right now, is those chip machine makers. Those are the ones that are, you've got to follow those because that's going to tell you everything that's going on. The ones that also that are getting very, very weak are those are your, again, your infrastructure stocks, which were really, really strong. Okay, they are starting to really break down now. Those are your big, well, let's put it this way here. You have your chip machine buyers, and then you have your mega caps. Those were very, very strong. But the infrastructure stocks, NVIDIA, MRVL, AVGO, MU, Intel, those are the big important stocks right there, the infrastructure. They've already been paid. They already got all the money. Their earnings are set in place. And by the way, I want you to listen to this. Play this cut.
Don't forget, markets can withstand higher rates for the right reasons.
What they're saying is, this is nuts. This guy, what is he, nuts? What the hell is he talking about? Yeah, they're saying if yields go up because the economy is strong, stocks won't crash. But there's a problem with that BS, okay? The market doesn't care why yields go up. It doesn't. The market doesn't care. Mr. Market don't care why yields are going up. It only cares, again, not why they're going up. They just care if they're going up. The why, who cares about the why? They don't care about the why it's going up. They just want, if they're going up, that's all they care about. They're going to hit 450 or more, that's all they care about. The computers don't read headlines. They don't care about the right reasons. You know, why this should do that and this should do that. Computers don't read headlines. They don't care about right reasons. They react to again, levels of volume and so forth. So this guy's nuts. This guy, this is absolutely the dumbest thing I ever heard. Dumbest thing I ever heard. So again, today and Friday, we're not a confirmed crash. Not enough volume, and we just don't have the volume, and we just don't have the credit spreads we need to qualify it as a real crash. So we're far away from a real crash. So make sure you're working with your relative strength stocks. Join our gang, will help make sure you're in the right stocks. Okay, but that's why you're seeing this volatility. We don't have what we need for a crash. Sorry to report that, but we don't. We will one day, but not now. I will see you on the charts.